Treasury and its role under risk, enhancing financial security through effective management. Presentation overview. Treasury management overview. An overview of Treasury management, including its objectives and functions, will be provided at the beginning of the presentation. Role of Treasury in risk management. The role of Treasury in risk management will be explained and how the two functions can be integrated for optimal performance and efficiency will be discussed. Best practices for integrating Treasury and risk management. Best practices for integrating Treasury and risk management functions will be shared, including how to effectively manage liquidity, foreign exchange risk, and interest rate risk. Challenges and future of integrated treasury and risk management. The presentation will conclude with a discussion on the challenges and future of integrated treasury and risk management. Introduction to Treasury Management. Objectives of Treasury Management. The objectives of Treasury Management are to ensure adequate liquidity, manage risk exposure, and earn a return on excess cash reserves. Types of Treasury Management. The different types of Treasury Management include cash management, working capital management, debt management, and risk management. What is Treasury Management? Managing cash flows. Treasury management involves managing an organization's cash flows to ensure that it has sufficient liquidity to meet its financial obligations. Managing short-term investments. Treasury management involves managing an organization's short-term investments to ensure that it has sufficient liquidity to meet its financial obligations. Managing financial risk. Treasury management involves managing an organization's financial risk by identifying and mitigating potential risks that may impact its financial obligations. Objectives of Treasury management. Ensuring sufficient liquidity. One of the main objectives of Treasury management is to ensure that an organization has sufficient liquidity to meet its financial obligations, such as paying suppliers, employees, and other creditors. Managing financial risk. Another important objective of Treasury management is to manage financial risk, such as interest rate risk, foreign exchange risk, and credit risk, which may have a negative impact on an organization's financial health. Optimizing cash balances. The final objective of Treasury management is to optimize the organization's cash balances, such as investing surplus cash in short-term instruments that offer higher returns and reducing idle cash balances. Types of Treasury management. Cash management. Cash management is the process of managing an organization's cash flow and ensuring that there is enough cash on hand to meet operational expenses and short-term obligations. Investment management. Investment management involves managing an organization's investment portfolio to optimize returns and minimize risks. Risk management. Risk management is the process of identifying, analyzing, and managing potential risks to an organization's financial performance and stability. Risk management in Treasury. Types of risk. Organizations face various types of risks, including financial risk, operational risk, legal risk, and strategic risk. These risks can have a significant impact on an organization's performance and objectives. Financial risk management. Treasury plays a critical role in managing financial risk, including interest rate risk, credit risk, and liquidity risk. Effective risk management strategies can help organizations reduce the impact of financial risk on their objectives and performance. What is risk? Definition of risk. Risk is the possibility of loss or damage to an organization's assets, earnings, or reputation. It can arise from various sources such as financial market dynamics, geopolitical events, cyber threats, natural disasters, and unexpected operational disruptions. Market risk. Market risk is the risk of losses in an organization's portfolio due to fluctuations in market variables such as prices of stocks, interest rates, and foreign exchange rates. Credit risk. Credit risk is the risk of default by borrowers or counterparties, resulting in losses to the lender or investor. Operational risk. Operational risk is the risk of loss due to inadequate or failed internal processes, systems, human errors, or external events. Types of risk. Market risk. Market risk is the risk of losses due to changes in market prices. It is often associated with investments in stocks, bonds, and other financial instruments that are traded in the markets. Credit risk. Credit risk is the risk of losses due to the failure of a counterparty to meet its financial obligations. It is often associated with lending and borrowing activities between financial institutions and corporations. Liquidity risk. Liquidity risk is the risk of being unable to meet financial obligations as they come due. It is often associated with cash flow, funding, and other short-term financing issues. Operational risk. Operational risk is the risk of losses due to inadequate or failed internal processes, people, and systems. It is often associated with the day-to-day operations of financial institutions and corporations. The role of Treasury in risk management. Identifying financial risks. Treasury is responsible for identifying and assessing financial risks, including market risk, credit risk, and liquidity risk that could significantly impact the organization's financial performance. Measuring and monitoring financial risks. Treasury measures and monitors financial risks to assess the organization's overall risk exposure and identify areas where risk management strategies need to be improved. Developing risk management strategies. Treasury develops and implements risk management strategies to mitigate the impact of financial risks on the organization. These strategies can include diversifying investments, using hedging techniques, and developing contingency plans. Best practices for integrated treasury and risk management. Centralized control. Centralized control is a best practice for integrated treasury and risk management. This involves creating a central treasury function responsible for managing all aspects of treasury and risk management. Risk identification. Identifying financial risks is a critical aspect of integrated treasury and risk management. This involves identifying and assessing potential risks to the organization's financial health. Risk mitigation. Risk mitigation involves taking steps to reduce or eliminate identified financial risks. This includes implementing strategies to manage liquidity, credit, interest rates, and foreign exchange risks. Integrated treasury and risk management best practices. Risk management culture. Creating a risk management culture helps to ensure that everyone in the organization is aware of the importance of risk management and that it is integrated into all business processes. Alignment of treasury and risk goals. Aligning treasury and risk goals helps to ensure that the organization's financial and risk management strategies are working together towards a common goal. Roles and responsibilities. Establishing clear roles and responsibilities ensures that everyone in the organization knows what their role is in the treasury and risk management process and how they can contribute to its success. Effective communication processes. Implementing effective communication processes ensures that information is shared efficiently and accurately between treasury and risk management teams, as well as with other stakeholders. Challenges to integrated treasury and risk management. Organizational silos. Organizational silos can be a major challenge to implementing an integrated approach to treasury and risk management, as they can hinder communication and collaboration between different functions and departments. Lack of resources. Lack of resources can be a major challenge to implementing an integrated approach to treasury and risk management, as it can limit an organization's ability to invest in the necessary technology and personnel. Resistance to change. Resistance to change can be a major challenge to implementing an integrated approach to treasury and risk management, as it can prevent an organization from adopting new technologies and processes. Future of integrated treasury and risk management. Holistic approach to financial risk management. Organizations are recognizing the benefits of taking a more holistic approach to managing financial risk by integrating treasury and risk management functions, leading to better decision making and improved financial performance. Emerging trends and technologies. Emerging trends and technologies such as AI, machine learning, and blockchain are shaping the future of integrated treasury and risk management, providing new opportunities for organizations to optimize their financial performance and manage risk more effectively. Conclusion. Criticality of treasury and risk management. Treasury management and risk management are critical functions within any organization. These functions help organizations manage financial risk, optimize cash management, and maintain liquidity. Benefits of integration. By integrating treasury and risk management functions, organizations can create a streamlined and efficient approach to managing financial risk, reducing operational costs, and improving decision making. Challenges of implementation. Integrated treasury and risk management can be challenging to implement and requires a commitment to collaboration and communication across functions. It also requires a comprehensive understanding of the organization's financial risk management strategy. Thank you.